Hey guys, welcome back. Okay, so it seems like every day we're hearing about SPAC this, SPAC merger that. The two most notorious ones are the DraftKings SPAC and the Nikola SPAC. One has made investors a lot of money, and the other has cost investors a lot, depending on when you bought and sold. Today, we will go over what is a SPAC and the strategies that hedge funds and insiders are using to trade SPACs so that you too can also make some money. By the way, if you like this video, please smash the like button and hit subscribe. So what is a SPAC? SPAC stands for Special Purpose Acquisition Company. It is a company created solely to merge or acquire another business and take it public. It offers the acquiring company a cheaper, faster alternative to an IPO. The company raises funds from investors, typically around $300 million to a couple billion, and then the SPAC, led by its financial sponsors, hunts for promising companies. The company has no operations, no assets, other than its newly raised cash, and thus in essence, investors are writing a blank check to the company. So how does it work exactly? Well, the early bird institutional investors and the individual investors who generally come in later typically pulls money into the SPAC. The SPAC goes public and is publicly traded. While the shareholders wait for the sponsors to spend the money, the SPAC generally places the investors' money in a trust or escrow account to keep it secured while the target company is publicly announced. However, sometimes it can take up to 2 years to pick and announce the target company that it wants to acquire. If it doesn't, the SPAC is liquidated and the funds raised are returned to investors with interest. If it does find a target company, then the two companies merge and become one listed public company. The idea is that investors of both companies will be rewarded by the value generation of the new listed company. SPACs in general are not a new idea, but only recently has it become mainstream. In 2013, there were 10 SPACs, and today, in 2020, there are over 127 SPACs with an average size of $384 million. Investors of all sorts, from Richard Branson to even Shaquille O'Neal, are coming up with new SPACs as a way to raise funds or cash in on the hype. Some analysts have even compared SPACs to the any business with a dot-com IPO craze in 2000. However, it doesn't mean that SPACs are bad. We just need to learn more about how to trade it properly to make money. Let's look at some of the advantages and disadvantages of a SPAC. First, SPACs are cheap. They're usually priced at $10, so it's very easy for ordinary investors to buy. The average increase this year in the first day of trading has been 1.7%. So buying in the market might mean just paying $10.17 or so. Hence, it is within reach of most retail investors. SPACs also offer individual investors the chance to get in on the ground floor of a potentially big stock, promising startup or trending sector which you may not get a chance to get in otherwise. For example, like the Airbnb IPO, which you would not be able to get in at the low IPO price. Of course, there are also some risks which we will cover later. Additionally, SPACs are public companies, so they are regulated by the SEC and thus offer some protection to investor. The disadvantage is that you're putting money into a blind investment. SPAC investors usually don't know how their money will be used, so the deal is impossible to evaluate. There can be a long lag between the time investors pump money into a SPAC and when it actually buys up a company and starts operation. Your money may sit for up to 2 years in a trust account. If no acquisition happens, your funds are returned, but you may have missed out on other investment opportunities during this time. Lastly, on average, SPACs, after its acquisition announcements, generally have poor returns over the long term. Retail investors and institutional investors who hold SPACs as long-term investments once a deal is struck haven't always done as well, as studies show that SPACs recorded a negative 14.5% median return in the 3 months after the merger. 12 months later, the SPACs they studied were typically performing even worse. Given the poor investment long-term, hedge funds are still pouring billions into a SPAC. 10 hedge funds own more than a quarter of all SPAC securities, and the top 75 investment managers hold almost 70%. Why is that? Well, hedge funds view SPACs as a fixed income substitute given low bond yields, with essentially no downside risks and considerable upside potential. The funds are often swing traders with no intentions of remaining investors once a SPAC has found a merger target. So how do they make money? Well, this is how it typically works. As we discussed earlier, at the SPAC IPO stage, early investors pay $10 for one share and will also get one warrant in the IPO. Warrants are additional incentives given to investors like hedge funds for tying up their money in a SPAC for a long period of time ahead of a deal. Warrants give the holder the right but not the obligation to buy or sell the SPAC stock at a certain price before expiration. Warrants are similar to options except that the warrants are issued by the company directly and are diluted because they are connected to new shares, while stock options are basically contracts between any two people and the company does not make any money from the transactions. So coming back to the process again, after the IPO stage, you have the deal announcements. And then the shareholders will vote to approve the deal, and then the deal closes. And then the shareholders now own the shares of the new combined company, which is basically the private company that the SPAC just acquired. For the hedge funds, the strategy is quite simple. They will invest early at the $10 stage. If the shares dip below $10, they will buy more because they know that the cash value is at least $10. Sometimes it will dip below $10 because of the market conditions, but will mostly be picked back up immediately and stay above $10. Then, once the deal is announced, shares will pop, assuming it is a good deal. But this is not 100% certain if the target company is not great or the valuation is too high. Hence, there is some risk, but is limited to the $10 redemption price. In general, once it pops, the hedge fund sells and cash out. Thus, as you can see, an individual investor can also follow this strategy. Get in early, buy at or close to the original IPO price, and sell on deal announcements. However, the hard part is that it is not easy to do part 1 and part 2. Here are some steps to help you get in early. Though you will not be able to get in before the hedge funds, you will at least be ahead of other retail traders. First, you can try to ask your stockbroker or wealth manager. Depending on how large your account is and who is your broker, i.e. Goldman Sachs or Morgan Stanley, then they may have connections to help you get in early. For most of us, this is likely not the case. Then you must do research using resources online. For example, websites like Early Bird Capital have lists of SPACs still seeking targets. There may be names that are not mainstream and not well known yet, thus the price will likely be still closer to $10. The NASDAQ website is also a good source as it also lists upcoming IPOs, including SPACs, which can be identified by a ticker symbol that generally ends with a U. Industry associations like SPAC Research sometimes highlight S-1 filings, which may give formal notice of a SPAC's intention to go public. Next, buying at or near redemption IPO price requires trading discipline. If you cannot get in early, you should be patient and wait for an opportunity when the price drops. Don't chase rumor news about SPACs because they will have already popped in price before you can even buy it. Overall, just keep a watchful eye for opportunities during market sell-offs or when interest in the SPAC has faded a bit and the price has fallen closer to the $10 price. Lastly, just like the hedge funds, if you do get in at a good price, sell immediately after deal announcements. Take your profits and move on to the next SPAC. Finally, SPACs are very speculative stocks. They are swing trades and not for long investments. I like the investment because there is limit to the downside risks, i.e. the IPO redemption price, and high potential upside if a good deal is announced. But to limit your risk, you should also read the SEC filings, as not all SPACs are the same. Some will have different terms and acquisition strategies, and you will also want to read about the target company once the deal is announced in the case you want to continue to hold. You should also stick with SPACs that have reputable sponsors. I don't know about a Shaq or a Paul Ryan sponsors, but definitely someone who is credible like Peter Thiel or Bill Ackman. They will have resources and connections to get a deal done faster and are very business savvy as far as locating good merger target. I hope this was helpful. Happy trading. Please don't forget to subscribe.